Hello, my name is Brad Muniz, partner at Sobel & Company, and I'd like to welcome you to Sobel Insights. Sobel Insights is a weekly series where we provide some brief information on various topics. Our goal is to keep these sessions to 15 minutes. At this point, we do not offer CPE. If you have any ideas for topics or speakers, please feel free to reach out to me. Our topic today is a really interesting one. I've dealt with this for years, and I'm so happy that we have somebody who's speaking on this, is cost segregation studies. Terri Johnson is a partner at Capstan. And Terri, if I could just jump right into this, what is a cost segregation study and what kind of benefits can they provide?
Great question, Brad. Let's get it going. So by the way, I'm really happy to be here today. And cost segregation is one of my favorite topics. Basically what it is when you own real estate, you depreciate that asset over a long life, either 39 years for commercial, 27.5 years for multifamily or nursing homes. So the goal is to move as much out of those longer lives into shorter lives, personal property being 5 or 7 years, land improvements being 15 years. And so what you want to do is move as much of that forward, and then you have it's basically a time value of money play. So if you move out into these faster depreciable lives, you're accelerating the depreciation. You're not changing the depreciation, you're just moving it up. So you're offsetting income with losses.
Right. Now, and that's what I've tried to explain to people that want to have cost segregation studies. They think that they're getting this tax benefit that they'll never have to ever pay tax. All you're doing is it's a time value of money where you're getting the tax benefit now, paying the less tax now. And yes, you will have to pay tax, not the same amount, but you will have to pay tax on the same amount of income ultimately. But it's better, as you said, the hardest one for people to swallow is to understand is that real estate, just in and of itself, you could say is 39 years. Okay. Now, at my age, if I bought a piece of real estate now, I don't know if I'm going to make 39 years. So I'd like to get as much benefit now. Are there any kind of properties that I know that real estate that do cost segregation studies, and are there any factors that make a property especially a good candidate in any way?
Sure, Brad. I mean, one of the things we always look at is the more you have, think about how you fit out a building for its special use. So if you have a plain vanilla warehouse that really has not a lot inside, but it might have some good land improvements, it's going to be on the lower, although it works, it's just going to be a little bit lower. But take that same size property and turn it into a refrigerated warehouse, for example, and you've got all this specialty equipment, you could be at 50 or 60% of acceleration on that property. We do a ton of multifamily, offices, retail, self-storage, mobile home parks. I mean, it really runs the gamut. Really, anything that you're getting, you can rent out, or you're paying either, it's your business and you're using it for business, or you're an investor or developer and you're getting income on that property, you depreciate it, you can use the accelerated method.
Interesting. Has anybody ever asked you just for a single family residential by chance?
You'd be surprised. I mean, one of the things right now we have under the new tax law, 100% bonus right now on anything we move into 5, 7, or 15 years. So you get all that, whatever you move under 20 years, you can take in the first year. So all of a sudden, think about single family, if single homes, you can depreciate anything you move into 5 and 15 year in that year. So let's say you buy something for $350, or it's a nice beach house for $1.5 million, and you're renting it out most of the time or all the time. That becomes a great rental property. We're now getting portfolios of those, Brad, where investors are going out and buying single family homes and using cost segregation on them.
That's interesting. I hadn't even thought about that. And now that I think about it, a friend of mine bought a house in Rehoboth Beach and is renting it out. And when you do the closing statement, we'll talk about performing the functions a little bit. But you get the closing statement, it's like I can estimate the land because I'll look at the card. The New Jersey, we have a card that gives the assessed value, but not saying that assessed value actually equates to the fair value. That's a different topic in and of itself. So I believe I know the answer to this because I've dealt with this, particularly in the self-storage area. Can the study be performed at any time during life, or does it have to be when I purchase it or construct it, type of thing?
You can really, Brad, do this anytime during the life cycle of real estate. So most commonly, you'll see it at acquisition, new construction, or renovation. But let's say you've owned a property for 10 years and you're going to put a huge addition on that, or you're going to change the use. Let's say it's an office building and it's just, you're not renting it out. You say, you know what, we're going to convert this to a medical office building. So you do a big conversion, a lot of work on that. You can write off assets you're removing and do a new cost seg on this huge renovation, sort of reimagining that property. So the cost seg becomes very important because the data that's in there allows you to say write off assets if you're repositioning that property or doing a big redevelopment down the road.
Yes, and now I had a self-storage facility, but they own the self-storage facility since 1976. Now, you're saying we could do it at any time, and that's fine. But anything that they wanted to try and move to 5, 7, or 15 year would have been fully depreciated anyway.
Right. Well, you couldn't do a cost seg before 87. But still, like you're saying, you'd be, for the most part, you'd be fully depreciated. Right. So you wouldn't do that. But if you had some new event, you would be able to, like you're a big major renovation, you'd be able to do the cost seg just on that renovation.
Okay. So we're talking about, performing these functions, and I'm hoping I hear the right answer from you. I think I know what it's going to be, and gosh, am I hoping you say it. Is a specialist required to perform these cost seg studies, or why can't, I'm an accountant, so I hope that the answer is not offensive, but I'm leaning the other way. Why can't accountants just do it, or somebody in-house just do these?
I mean, the problem with, if you do it versus our folks do it here, you're going to get a very different result. And so I call it, you're going to get, Brad, the low-hanging fruit, something that's really obvious. But we're going to get, all this specialty electrical and specialty plumbing and things that you would not be able to do the takeoffs and be able to get to those numbers. So we're going to get a much more detailed study. And the thing is, the IRS wants to see if they ever audit you and they're looking, they want to see that this was done by a third-party professional. And that's part of the, it's going to give you a lot more credibility if you've got a third party that's following the IRS audit techniques guidance documents and other guidance documents and revenue rulings that have come out versus doing it kind of what I call back of the envelope. Sure, you're going to get a little bit of it, but you're going to leave a lot on the table. And trust me, for the fee that you spend versus what you get out of the cost seg, it's a no-brainer to me.
Right. And I mean, I don't know the makeup of all the people there. I've worked with your company over many years. I imagine that you have engineers that are on, maybe architects also. And I know I personally, maybe there's somebody here in my office, there actually is somebody who was a chemical engineer, but I'm not an engineer. I have done very little handiwork like that. I would not be able to break it up. And I had a client say to me one time, well, why don't you just do it? And I said, well, how am I going to do it? I don't know what went into this building. Well, we'll look at the AIA, the American Institute of Architects form that shows from the contractor how they did it. But I don't know what electrical was taken out of the walls, which might have to be 39 years, and is part of the equipment, which could be 5 or 7 years type of thing. And if I do it, I'll have a fancy Excel schedule maybe with some cool formulas, but compared to the report that I've seen that's provided by an organization like yours, there's depth to it and there's support that's provided in there. And yes, and I do get an Excel schedule, so I felt I could understand that completely.
Well, and you make a good point, because all the, we're doing our work under the IRS audit techniques guidance document. And then the thing is, the electrical is a great example, because if you take a one line item out of an AIA that you mentioned, maybe it's $2 million for electrical. We might blow that out into 60 lines, and it's divided between personal property. And it's also got 39-year assets and things like that. So you're not just, it's not one or the other. It's usually a hybrid.
Right. Yeah. And the other thing in particular, I had to look it up this year because they put a sign in. And there's special regulations as it relates to sign, if it's wall mounted or if it's a monument type of sign.
Monument signing, a sign, yep, they're
Yep.
like a monument sign would be a land improvement versus if it's on the side of the building, it's a personal property. So how would you expect every accountant to understand all those rules and the nuance? I mean, you guys do so much. You wear so many hats. I can't imagine that you would want to get that detailed into how to depreciate a monument sign. So
The hat that I like to wear is to know the people to go to help out in these situations. And this is one of the situations.
well, that's why you make a great client, because you are very proactive about getting people, getting the right advice and getting the right studies done. It makes a huge difference.
So we covered what are cost seg studies, the type of properties that go in, and who's the best people to do it. Is there anything in particular that's coming up in legislation that we should be concerned about?
Yeah, I mean, well, one of the things that it's passed now, but I think we should be very aware of, is that when the CARES Act came out, they fixed the glitch that we had in qualified improvement property. So if you are looking to renovate your building, it's a commercial building, you can use qualified improvement property, which is a 15-year asset. You can take bonus on that for all the real property. So if it's an improvement to the interior portion of a building, non-structural, and doesn't increase the footprint of the building, it could be considered qualified improvement property. And then you'd also have personal property associated with that. But this is huge. So let's say you're doing $1 million renovation and 80% of that qualifies for QIP. That's $800,000 deduction. That's huge. And that was a big change on the CARES Act. And a lot of people just aren't quite aware of that. So I think that's an important point. The second thing I wanted to bring up is on the timing, that the bonus appreciation that I've been talking about, the 100% bonus, at the end of this year, it's good through the end of this year. And then starting next year, it starts going down 20% a year. So in 2023, it'll be 80%, following year 60% until it expires in 2026. So if you think about this, remember, this is for acquisition, renovations, and new construction, and you're budgeting a project that's going to come online in 24, thinking you're going to get 100% bonus. You need to be modeling to understand that those levels are going to start going down unless the legislation, they change it and bring it back permanently, which we're not really hearing much about that right now. So
Okay.
that's a biggie.
That's good to know and watch, and I don't want people here to think, well, if I'm not going to get bonus, I'm not going to take it. Well, I'd still rather have something out of 39 and in personal property or in 15.
Right, and you still have through 2026. I mean, it's the longest time frame that we've had to plan projects ever for bonus depreciation. So, as I say, 80% is still pretty good for next year. So
I'll take that.
Get those projects done, Brad.
Right. All right. Well, those are my questions. I want to thank you. And as I say to many people, many times when I have presenters like you on, talk to the person that knows the area the best. And this is one of the people who knows the area the best and understands it. And don't try and do this on your own, or reach out to your accountant, and we're going to point you into a person like this that's going to do it. So thank you very much for presenting, Terri.
Well, thanks for inviting me, Brad. It's great to be here today. Thanks so much.